It's a great pleasure to have you here. And today we are focusing on one of the key interesting aspects today in finance, the idea of sustainable finance, and looking at sustainable future. Sustainability, as you know, is a key aspect of the SDGs, at least in some 17, and extensions. But also the way we have looked at sustainable finance here at SOAS, there are actually two research centers, both of them looking in aspects of sustainable finance. But the Center for Global Finance looks at it from the aspect of, global finance, issues of the banking sector, climate finance, as we did last week. No, but today we are just taking stock of the financial drivers, the challenges, especially for banks. And we are very fortunate today to have with us three reputable scholars working in this area. So we welcome the three co-authors who have put together this particular paper. And they are all from the Lille Catholic University in France. We have a strong collaboration with this institution. In 2019, before the lockdown, they ran a great conference, international conference, where they were looking at finance and growth aspects, and they invited me to give a keynote. I was happy to do. And then a couple of months later, Sandra came to one of the Center for Global Finance conferences here at SOAS. So we've got a good track record in terms of the collaboration. But let me take the opportunity to introduce the co-authors. I know that you may have met them in one or the other, but it's a great pleasure to have them introduced to you. Sandra Kendo is an associate professor of monetary and banking economics at Lille Catholic University. She's an active researcher within the African Economic Research Consortium, Group C, which I chair within the consortium. But she's also a member of the Sustainable Cities Lab, researching globally on some of these issues. She has traversed many areas of banking and finance, focusing on impact investing, which is of great interest now within the FCDO, sustainable finance, and financial stability. And at the moment, they are working, she's working with the other co-author here, Qing, developing an applied research projects to be funded which is funded between last year and 2026, which is looking at the regional aspects in France. And they're trying to construct a financial and extra financial composite index for small and medium enterprises. That's very interesting because that's a project that is of great interest. Also, the Center for Global Finance, and to many of the participants in the seminar today. So you are welcome, Sandra. Let me also have the opportunity to introduce Baran Siyahhan, who is an associate professor of finance at the same institution, Lille Catholic University. And he's a member also of the Sustainable Cities Lab. Has very key research interest in corporate finance and industry organization, especially focusing on themes in entrepreneurial finance, platform economics, sustainable finance. These are key hot areas today, especially the way finance is being reconfigured globally. And the third co-author is Qing Q. I hope I pronounce your name correctly, and pardon me if I don't, who is also an associate professor of finance at Lille Catholic University and an associate member of the Gredig research team in CNRS. Received a PhD in economics from the University of Côte d'Azur 2014, As research interest in fintech, especially in M-payment in Asia and Africa, exporting the M-payment models to other countries, but also in fintech development, digital currency, and social finance. And I think our research interests overlap. So we are very fortunate to have, three stars, three eminent researchers to take us through this afternoon on issues of sustainable finance, interesting agendas, policy questions. And as usual, I'd like to call upon participants to be very generous with their comments, feedback, constructive ideas, highlighting policy issues, theoretical issues, and also insights in terms of what appears on your radar. You know, in a research seminar like this one, no comment or no feedback can be trivial. Every feedback counts. Whether it eventually ends up in a footnote or changing an entire research project is a matter for the researchers to take on board and consider and be responsible for. But we ask you to post your comments in the chat, or if you wish, you can interrupt the presentation. But if you post your comments in the chat, then we can have a lot of more constructive time after the presentation to do the cut and thrust, exchange views, comments, and so forth. So, I understand it's going to be a three-person drama where the three participants will be speaking, in turn. So for now, let's put our hands together and welcome the trio, the presenters, Sandra, Baran, and Qing. Please go ahead.
Thank you, Victor. Thank you to all of you to be present and maybe to be around this afternoon. And we really, really appreciate the time that you dedicate to our research work. So as it is introduced and as Victor already underlined about our topic that we want to share this afternoon with you is around sustainable finance. And maybe the issue that we want to raise is that we want to open the debate around this question of sustainable finance. And if I can maybe shortly say it, 3 lines or maybe announce 3 lines about what we want us to maybe focus on around this paper is around the understanding of sustainable finance that we can have, because I think that most of you and most of us, we are maybe aware about the concept now, and there are several papers that are just working on sustainable finance or maybe green finance, and we have several issues like that that are already published. And maybe our concern about the concept of sustainable finance were raised about the fact that on the different papers, they were just mentioning specific areas that were just explaining sustainable finance. And when we were just combining this with also some debates that were raised around, during some conference and seminars, we heard that maybe something could be developed around the understanding of sustainable finance by gathering what could be the keywords that we can just include in the sustainable finance concepts, and maybe also some important areas that we can just consider also to maybe enrich the understanding of this concept. And the link with the sustainable future is just because also, as we are now aware about several issues that I will present later. So there are some importance that are just given on how we can maybe more or better or wisely invest nowadays to maybe better protect our planet, our environment, and so on, and maybe to leave something significant to the next generation. It is why about our title, we just focus ourselves on the sustainable finance aspect first, but to think about the future, how we can just develop or maybe try to deepen our thought to design some policies that could be more sustainable in the future. It is why also the second important aspect of this main concept, those two main concepts, are to try to take out, or maybe not take out because it is already existing, it is trying to collect and maybe have a clear overview about the current challenges that we have nowadays, and maybe the different financial drivers also that now about the banks, that the banks can use to maybe more develop a finance in a sustainable manner. So those are the two main aspects. And maybe for those who read a little bit our short summary, we say also that we will start by introducing a model, because we think that a theory that we have gathered, we can combine and enrich this theory by translating with some equations. So we have a starting beginning of the thought about the model, how we can also try to put down the things as equation. So due to this, if we can just maybe, so about our presentation, we will just organize at those three levels. So open the debate about the understanding of the sustainable finance concepts, and why is it so important is the beginning of the thought. The second big area will be around the drivers and the challenges, and the last part will be how the financial theory has been improved and what is maybe the main important part that we can just consider now to improve the model for the financial theory. So, thank you, Qing. So about the beginning of our thought, as I was just announcing, it is all those important issues, or maybe emergency that we have to handle nowadays, related to how we have all those modification of the environment, how maybe we have climate change issues that we have to take in consideration. And maybe another aspect that I can underline here is also how all those modifications about the environment, the climate change issue, are just modifying the social aspect, means maybe how we are just behaving as individuals, and also all those modifications that are just appearing in the society. So we have to think also about a new restructuration of our society and how we can maybe efficiently organize the things. So due to this, we have this part of the Paris Agreement that is most cited also as the core one that helps us to maybe pitch and maybe have a better insight about all those challenges. Among the 29 articles of the Paris Agreement, what sounds a little bit more fitting with our research work was the second article that was cited in the Paris Agreement. And for the second article, they raise, of course, the issue of the temperature that has to be handled, the low gas emission that has to be also handled, of course. But what sounds interesting is that for those climate change issue and the modification of the environmental side, we have now to think about how the finance could be improved to more fit with those challenges, with those important issues that I just mentioned. So the second article of the Paris Agreement is maybe more interesting for us according to the financial side that we want to develop and maybe share with you this afternoon. So according to this, by just putting in place all those important aspects about all those modifications, of course, related to the environment, to the society, and to the social aspects, we also stand a little bit ourselves and ask the question about what we really mean by sustainable or sustainability analysis. Because we have also for those maybe problems that we're just mentioning, and all the maybe in several papers also we saw that they talk about we have to develop a sustainable process in a transitional production process. We have to have a sustainable policy, we have to have a sustainable action, we have to have a sustainable way. So a little bit we just ask ourselves in the paper also, what do we mean sustainable, and how can we link the concept of sustainability with finance? It is why also when we look about a little bit the definition of sustainability or maybe a sustainable approach, we saw that all the time when they want to maybe clearly define the sustainability analysis or a sustainable approach, they relate with sustainable development. That makes sense also. Why? Because according to the sustainable development, we know that the United Nations has clearly designed 17 objectives that has to be fulfilled to maybe have also this sustainable approach. And around those different 17 objectives, of course, if we can summarize and combine all of them, is just according to how we can more value the utility of the different economic agent. So the profit for the firm and the wealth for the firm and the household. So due to this, to have a good sustainable finance, and we can just extend this notion to sustainable finance, we have to balance the information between the profit level of the different firms or maybe the different institutions in general, and take care about also the welfare and the well-being of those different economic agents, basically the firms and the household. It is why here in the sustainability analysis related to the financial side, of course, we have the economic issue that is just appearing as really important, and we have to complete with this other important side related to the ESG part, where we are just raising those environmental issues, social issue, and also a governance issue. And to and maybe for also for the last line to complete also the way we are just putting down and trying to put in detail the sustainability analysis. We have also this bottom line that try to link and give just a simple view of the sustainability analysis. What are the different main aspects that are just value in the process? We have people, profit, and planet. So the tree of the bottom line is just given a strong core of this understanding of sustainable finance. So this is one part that sounds maybe interesting in our analysis. Then, no. Thank you. So then, according to the financial side, by putting down those three important areas that we have to value in the process, the people, the profit, and the people, the profit, and the planet. So according to those three aspects, of course, we just relate ourselves, and it is why we have just raised all maybe those three short questions that help us to understand how finance could maybe better fit the different challenges related to the ESG factors. So the first one is how finance can be improved to more contribute to the sustainable and inclusive growth through funding an institution in the long-term needs. And of course, it makes sense here for the long-term needs according to those challenges that I have mentioned at the beginning related to the environmental, social, and governance side. The second important one was how can the financial system facilitate decision-making on the trade-off between economic, social, and environmental goals. And this sounds a little bit interesting about the trade-off side. You will see why later, because of course we have the issue of make profit. And we know for all those firms, it doesn't matter if it is a production firms or maybe a bank, all of them, they need to make profits. But we have to balance the idea of making profit with those non-financial issues that are just raising as a more considered situation that we have to introduce in the decision taking and decision making. So the third question that we raised related to also the sustainable financial side, that sounds a little bit interesting to try to improve our understanding, is how investment decision making include those ESG factors. So we have a challenge here on how to include this part and of course to ensure that the financial system will remain stable. So about the definition, if we just keep in mind a little bit those, I can say, important aspects that I've already underlined, it is really logic. It is really logic that in several studies, when they just define sustainable finance directly, they relate with how the different firms are just valuing the ESG issues. So several times we will name and define sustainable finance around how they are just overcoming and including those part of the environmental, social, and governance sides. And what we saw, according to some report, is that sustainable finance is not only the ESG analysis. If we can have, so the sustainable finance is not only narrowing on the ESG story. Why? Because for the ESG story, most of the time when we look about how it is applied, it is a matter of how and a matter of mean. And there is another avoiding part that is starting, that some study are now starting valuing, not maybe in terms of article, but in terms of reports, scientific article, I mean. So the avoiding part is the part of impact. So by combining maybe the analysis of sustainable finance with the previous one, the how we can implement, the mean that we use to implement such ESG issues, now we have to integrate also to make our analysis to be more complete. We have to integrate maybe the part of impact. What are the different modifications that we can observe because we have already initiated such kind of actions. So to complete the overview of the sustainable finance, maybe what we propose here is that we have to combine the ESG analysis with the impact analysis to have a global overview of the definition of sustainable finance. It is why here, by looking about the different big areas that could be introduced in the sustainable finance analysis, we just assume and we just value the fact that we have already at the basic level the ESG factor or ESG analysis. And of course, because all of them are just interrelated, we have responsible finance that could be included in the concept of sustainable finance, investment impact, solidarity finance, social finance, and the last part is the sponsorship. So let me give some few words about responsible finance that I can, as I said, they are all interrelated. So for responsible finance, when we just focus a little bit about this, we can see that in several papers they will raise what we mean corporate social responsibility. And when a firm, for investors or maybe for banks, when they are just granting funds for a sustainable finance approach, they need at the beginning, for the first level, to have an enterprise who is engaged with a CSR approach. So this is the basic one, and it is why here we mention the fact that it sounds important also if we want to enlarge our understanding of sustainable finance to take in consideration those beginning splitting part of the literature. And maybe the second important one that we want to stand a little bit more on is the impact investing. As I've mentioned, for sustainable finance, we have the how, the mean, and we have the impact. So if we keep in mind maybe those three levels, how, mean, and impact, we have a global view. And maybe to well have the view of the sustainable finance, we have in some papers, they will talk about impact investing, and in other papers, they will clearly state the fact that we have finance impact. So sometimes the two can seem as confusing, but they are just sharing the same story. So about the impact investing now, it is how for the different banks or maybe for the different investors when they are just granting loans or maybe when they are just making their funds available to expand the production of a firm, they want to see some results, some changes, some modifications, some positive externalities, as I can say like that. So according to this, when they grant loans or maybe when they just make their fund available, we can just distinguish also two types of enterprise. Those who are just creating at the beginning to just fit those needs of changing, environmental changes, social changes, and governance changes, or maybe existing firms that needs to change a little bit their process to fit more to the different new issues related to ESG. So about the impact investing, we will have those 5 characteristics that will be just assigned to trying to describe the finance impact or impact investing, intentionality, additionality, how the different assets in the whole portfolio of the bank or maybe the investment fund is just handled. And another tricky issue will be around the measurability. What is the right measure, the right indicator that could be used to well take out the impact, to well take out those positive externalities that we are just waiting for? And maybe what I want to mention about the impact investing, about the impact, when we talk about sustainable finance in the literature, it is clearly mentioned that it is a positive externality that we are just waiting for. So when there is negative externality, it is a part which is treated at the beginning of the process. So the ending process that we expect to have at the end is a positive impact. It is why sustainable finance at the end, as a result, for what it is clearly mentioned in the literature, we are just expecting positive externalities or positive changes. So about those 2 categories, as I was just explaining, when a bank or maybe an investment fund decide to provide such kind of loans or funds, they have to be aware about the type of enterprises that they are just supporting. Maybe a one who is creating for, so we are expecting to have positive externalities at the end, or maybe those who are already existing, additionality concepts, and we are just hoping to have some changes that could be just implemented in the process to more fit to those ESG challenges. So now I share a table which is just trying to summarize a little bit for those 2 big parts that has to be maybe integrate and take in consideration in the sustainable finance analysis, the ESG analysis and the impact practices. So I have just trying to split clearly into and to show also how when we take in consideration for the first line of the table, when we just take in consideration how the transformation process is just taking place in the society, how are we just considering ESG aspects. So we will see also for the ESG consideration that we have the basic one, where it is just a matter of greenwashing because we announce something, but it is not really doing, we are not really doing the thing. And little by little, the enterprises will be more responsible or maybe more engaged in the process. So this is the whole part without impact. So for the 3 first column, which is shared around ESG analysis, it is also the how and the mean. And the last part of the last column of the table now, it is around the impact. How can we just have such kind of externalities? What are we just expecting at the end when we are just funding such kind of when we are just funding such kind of loans or maybe funds? So.
Okay, so I continue for the drivers and the challenges of sustainable finance. To well understand the sustainable finance, we start with drivers. So for the drivers, we separate drivers into two different categories: the internal drivers and external drivers. Internal drivers, we focus on some drivers within the banking sector or banking industry. And for the external drivers, there are three different levels of initiatives. For example, United Nations initiatives, reporting initiative, and the country or region initiatives. So for the internal drivers, first of all, the World Bank had formed the environmental and social framework for financial institutions in order to define their role in reducing pollution and managing their adverse social and environmental impact on the economy. And generally speaking, there are four main principles of environmental and social policies for financial intermediaries. First of all, objectives and policies. They mentioned that banks should set up clear objectives and policies in order to ensure that their clients and their financial activities meet the requirement of both national and international recognized performance standard. Secondly, the risk categorization and management. They mentioned that banks should set up clear ESG criteria or sustainable finance criteria. Banks should screen all the clients and their own transactions against the well-established criteria and then try to classify them according to the potential environmental and social risks. And then about due diligence, banks should conduct ESG due diligence for all transactions. Banks should check periodically whether the using of funds is consistent with the intended purpose and the banking principles. This suggests the bank to try to visit the client's set in order to identify some potential environmental and social risks. And why not try to access the potential risks and to propose some proper action plans in order to manage the potential risks. Last point is monitoring environmental and social performance. Banks should monitor the client's compliance with environmental and social norms by taking periodic reports from them and also by conducting periodic client site inspection. And then the second driver is about the development of green bonds. As you could see, this figure shows that the issuance of the green bonds has been growing at a very fast pace in the last 10 years, especially in the European Union. We could see that according to this figure, the volume of green bonds increased from 1.8 billion euros in 2013 to 467 billion euros in 2021. And this figure shows that the green bonds issue volume in 2021, we could see that the European Union is one of the important regions to issue the green bonds, followed by China, United States, and United Kingdom. And now for the external drivers, I mentioned that we separated the drivers into three levels of initiatives. First of all, is about United Nations initiatives. In 1992, the United Nations Environmental Program Financial Initiatives was established in order to set up a global sustainability framework and to encourage all of its members to implement a sustainable and responsible finance framework. And then in 2006, the Principles for Responsible Investment, PRI, set up the 6 important principles for responsible environment. And until November 2022, there were more than 5,000 institutional signatories to participate in the PRI. Moreover, PRI encouraged all of these signatures to think about ESG related risks and also sustainable finance issues, and they try to encourage them to integrate ESG issue into their investment practice and investment process. And then the second level of external drivers is about reporting initiatives, because not like the traditional financial data financial resources, we don't have a consistent or very clear standard about how to disclose this ESG data, ESG information. So thanks to this reporting initiatives, is an external drivers for sustainable finance. So in 2015, the task force on climate related financial disclosures, TCFD, sets up the most important international framework, and they also give some recommendations for the reporting climate change risk and also opportunities to the global financial systems. And what's more, TCFD also provides financial institutions and firms with a very clear framework and a series of recommendations to assist investors, lenders, and some other financial participants in order to forecast the potential risk linked with climate change, and also try to discover some financial opportunities. And in European country in 2021, the European Union corporate sustainability reporting was established in order to give large companies and the clear standard to help them to prepare some regular reports based on their activities, social and environmental impact. And this corporate sustainability reporting try to facilitate policymakers, investors, and some other parties to access non-financial but material performance information. What's more, the global reporting initiatives also issue different theory. For example, the GRI 3000 and GRI 4000 focus on environmental and social issue and subjects. And then for the country and the region initiatives, I'd like to start with the European countries, because Europe is one of the important regions for the sustainable finance. In 2020, the EU taxonomy was established by the European Commission. It's the first classification for the environmentally sustainable economic activities. And 1 year later, the Sustainable Finance Disclosure Regulation was set up in order to make a clear requirement for the financial market and to try to enhance the transparency of the sustainable finance products, and in order to prevent the greenwashing issues. And then in 2022, the EU mission Climate Neutral and Smart City was announced in order to deliver 100 EU cities from its member states into a climate neutral and smart cities by 2030. And some countries in Asia also will participate the sustainable finance development. For example, in 2016, the Asia Investors Group on Climate Change was created in order to encourage all of its members to participate within the sustainable finance events. And Japan is also one of the important country for the development of sustainable finance. For example, the Ministry of Environmental of Japan first issued the Green Bonds Guideline in order to help financial institutions to well classify the expected the green bonds features and also guarantee the green bonds credibility, and also try to avoid the greenwashing. Also, there are some other examples about other regions and countries. And now for the challenge of sustainable finance, I'd like to present first of all some challenges linked with the implementation of sustainable finance or ESG investment. First of all, prior to implementing sustainable finance, people may have a very narrow interpretation of ESG investment objectives and sustainable finance. And sometimes we maybe feel reluctant to integrate ESG factors into our decision-making process. And once we make decision about implementation of ESG investment, we will also face with some problems. For example, insufficiency of necessary resources and the lack of ESG expertise and skilled individuals. So we will also meet some significant challenges to the sustainable finance. And source challenges is also one of the big challenges for the sustainable finance. When I talk about source challenges, it's about data disclosure and data collection, because not similar with the traditional financial data, there are various types of ESG related data and information. We need to collect the data from different way, for example, from videos, blogs, social media, some conference, some speeches. So it's a challenge for researchers to collect enough and useful information. And the second point is the ESG disclosure quality and scope still vary among different companies, because even the company try to make disclosure about some ESG issues, but there's no clear requirement for the company. That's why there's still a big difference among countries of the ESG disclosures. And nowadays, more and more rating agencies start to use different methodology to provide some ESG index. For example, MSCI ESG indexes, S&P 500 ESG index, Morningstar, Sustainalytics ESG rating. So even though we have a lot of ESG related rating or index, but for the same company, different ESG rating agency could give some different ratings. So it's also a resource challenges for the sustainable finance. And then from the point of view of asset owners, for example, asset owners are some banks, pension fund, endowment, foundations, family offices, and these asset owners may also face with a lot of challenges. First of all, they may be unsure about how to integrate ESG criteria, ESG issues within the request of mandate. And secondly, they may feel reluctant to integrate ESG even within the mandate. And the last point is the lack of ESG financial consultant or advisor for asset portfolio management and asset allocation. And then from the point of view of asset managers, because asset managers need to make the due diligence to do some security selection, portfolio management, and even the engagement. So if the asset managers would like to conduct a passive ESG investment, thanks to different ESG index, this ESG criteria or ESG issues may distort the weight of selected sectors or countries in the portfolio, comparing with the basic benchmark, which will lead to a high level of tracking error problems. This is for the passive ESG investment. And then for some managers, they will use a quite active ESG investment. In this case, the resource challenges and the lack of ESG integration method will be the big challenges for the active ESG investment. And the last point is sometimes according to the portfolio management mandate, we don't have managers won't have a very clear signal from the mandate, because sometimes there will be some trade-off between short-term profit and long-term profit. So all of this are some challenges for sustainable finance.
Okay, so maybe let me share some few words before giving the hand to Baran to present the model. So to summarize a little bit this part about maybe those several pieces that we were just sharing about the understanding of sustainable finance and the clear presentation of the different challenges and drivers and all those pieces of important information that we have to take in consideration. So we just take a part of the financial theory and just see how the modification is just taking place according to the traditional model and now the sustainable finance model. As you can see, for this equilibrium process, which is a famous one that we have in finance, so the trade-off between risk and return. So now the trade-off is also for sustainable finance, risk and return, but we have to add this part of sustainability. So the tricky issue is around the adding part of maybe to give some announcement about this, the ESG risk, or maybe several other risks related to climate change that Baran will present to us in a few minutes later. And also we have also to integrate maybe how the banking sector or the financial sector can maybe develop new financial product that are fitting those needs of sustainable projects to be developed, and keep the idea that we have to balance the risk and return trade-off. So due to this, we have just shortly trying to summarize the challenge about how a sustainable sustainable project could be developed. So on the x-axis, you have the idea of developing a project in general. But we keep in mind, we haven't put here the keyword of sustainable, but the issue here is trying to finance a sustainable project. And of course, about the decision that we have in the financial area, the bank or a fund will take the decision to reject or accept the project, to finance the project. And maybe what sounds interesting here, it is not about the relationship that we have just put in place, because normally and logically, we know that if the profit is below the cost, the bank will not involve at a certain level. So it depends. And maybe what sounds interesting, and it is not appearing here, it is all the debate which is in the back of this picture. Means that when a bank decides maybe to finance a sustainable project, of course, it is because nowadays in the short term, we have several financial aids which are just put in place, maybe by the central bank or maybe by the different government to try to sustain those processes in the banking sector. And also we have new policies that are just developing by the bank to also try to involve themselves in such kind of sustainable project and those different new instruments that are used, the literature called them as credit impact or loan impact or sustainable loan. So we have such kind of new product that hard now for the different bank to be on the right side now of the figure and to accept such kind of sustainable project, where they will have economic profit that will be greater than the ESG cost that they have to bear at the beginning. So this picture is just also introducing all the different, I can say, all the different issues that the bank has to handle in the short term. Why do we have such kind of financial aid? It is because we have a huge area of uncertainty. Bank cannot really value measure those different climate change modification as Qing has presented previously. So we have also a lot of debate about the right instrument that the different banks or maybe policy makers could use to measure the different impact, or maybe measure the financial needs that they have to assign to such kind of project. So this area is based on uncertainty. It is why for the environmental cost, we will have this curve, which is just shifting like a snake. And for the other curve now, in the long-term process, we will see that in the long term for sure, and we just assume after 15 or 20 years later, now we will have a line for the environmental cost because the level of uncertainty will be reduced. So due to this, we will have a clear evaluation of the uncertainty and a clear, and we really hope so, less debate about the right instrument that could be used as could be used to well measure those ESG impacts. And because of this line, horizontal line will appear, and we will have, of course, for the economic process, we have also the curve because it is an up and down process for the economic level to allow the firm to renew itself. So those two graphics are just trying to put in place the different changes and maybe also the different new areas that we have to take in consideration in the financial theory to improve our understanding on the sustainable side and try, and our focus for our paper is this model of risk and return.
All right, so I think I will now take over for the final act, act number 3 of the drama. So far we have talked a little bit about the overview, the definition of sustainable finance, different regulations, challenges. But on this final act, what we would like to do is maybe a bit more specific on the operational level, because if we're going to have firms basically investing in ESG projects, as we might call them, or improve, kind of cut down on their carbon emissions, they're going to need investments. And of course, those investments will need to be financed, and those, of course, will be financed by banks or syndicate of banks. But of course, these financial institutions in general and banks in particular may face certain trade-offs, and so different incentives in terms of banks' loan decisions. So on the one hand, you have financial institutions or banks who would like to basically finance projects that would basically improve the borrower's ESG profiles. And if you're going to do that, of course, you need to offer loans at attractive rates, maybe lower rate loans. And there's already some evidence that banks are engaging in such kind of loans. So for example, if you look at the paper by Houston and Shang, we already see that high ESG banks, so here it seems that whether the bank is itself a high ESG or low ESG also matters as well. So these high ESG banks tend to lend to also high ESG corporations, or once they make the loan, they become really adamant about bringing about change in the borrower's ESG profile. And they actually find that this is not true for low ESG banks. So there's already this distinction between high ESG banks and low ESG banks, and banks are already engaging in loans that incentivize companies to invest in, let's say, improving their ESG profiles. So that, as I said, requires at a certain sense loans at attractive rates. But of course, as a bank, you also need to take care of the risks, both conventional and non-conventional risks in a loan decision, right? So if the borrower is risky, so high credit risk, you want to charge a higher interest rate. But on top of those types of conventional risks, within the current context, we also have what we may call non-conventional risk, or the risk that banks perhaps did not consider 20 or 30 years ago, such as the physical risk or transition risk. So what do I mean by physical risk? What I mean is basically the direct impact of, let's say, climate change on the borrower's property or asset values, right? So if there's an extreme weather event, or the company is somehow headquartered or has a lot of branches in areas where it is exposed to sea level rises, so that poses a significant physical risk. So what does this mean for the bank? Well, it means that, first of all, the value of the company's assets as collateral is pretty much difficult to assess. And with the extreme weather events, of course, those risks may realize. And then, of course, there is the transition risk, which basically means the societies in general response to these types of physical risk or climate change in general. So it could be changes in regulation, it could be more litigation or changes in consumer preferences, which of course in turn affect the credit risk, right? Because if consumers change their preferences, if they are not buying the company's goods anymore because of their ESG profile, well, that affects the company's cash flow generating ability. So they kind of are correlated to a certain extent. So once you take all those risks together, of course, that puts a different pressure on the interest rate the banks would like to charge on a loan. So what we think about in this model is kind of this trade-off between a borrower's, let's say, ESG risk and these types of conventional and non-conventional risk. So for example, we're going to call a firm or a borrower a low ESG risk if that company already has a high ESG profile ex ante. Ex ante means before the loan agreement, and they are basically willing to engage or commit to making improvements in their ESG profile. And once they set ESG targets, they're able to attain those targets. So those types of firms we may call the low ESG risk firms. The opposite is, of course, would be the high ESG risk. So ex ante with low ESG profile, perhaps reluctant to engage or commit to improving their ESG profile, or they don't do enough to reach ESG targets once those targets are set, perhaps greenwashing firms. So we can think about perhaps these 4 different cases where we compare the ESG profile of the company versus the typical risk that a bank would consider, right? So if you have a low ESG firm, a low ESG risk firm, but this firm is kind of in a high market risk or physical risk environment, that would put opposing effects on the interest rates that the bank would charge, right? The low ESG risk would say, okay, so we could charge lower interest rates on this firm, whereas the market risk on this firm and the physical risk exposure would mean that the bank would need to charge a higher interest rate. And at some point, of course, in certain cases, the both effects could move in the same direction. So if we have, let's say, a high ESG risk firm and that is also exposed to high market risk or high physical risk, so the effects of both of these environments would basically force the bank to charge a higher interest rate. Or if it is a low interest rate, a low ESG risk and a low physical risk company, then again, you would have a reinforcing effect of these 2 forces, but this time in the sense that the interest rate that would be charged would be lower. So what we would like to do is to basically look at these different environments, this trade-off between, let's say, a bank trying to encourage companies to engage or commit themselves to improving their ESG profile versus this accounting for traditional risk and complemented by, of course, the physical risk and the transition risk. And we think about these ways to basically structure the loans in such a way that we can basically address each of these trade-offs or each of these different cases. So we're going to look at, in this paper, at the sustainability-linked loans versus standard loans. So we're going to ask the question, well, are sustainability-linked loans better suited to some of these cases that I just outlined, so these different trade-offs, than others? And well, perhaps for some others, a standard loan contract would do just as fine as well. So this is kind of the first stage. And then in the second stage, we ask the question, well, at the portfolio level, what would be the optimum mix between, or the good mix between the ESG loans and the non-ESG loans? So you might be wondering why we're asking about the sustainability-linked loans. But before that, let me tell you what I mean by the sustainability-linked loan. So when we think about a standard bank loan, it is typically the result of a bank's due diligence on a company. So you evaluate the company's cash generating ability, you look at accounting ratios, and then taking into account the risk, the credit risk, the bank comes up with a certain interest rate. With the sustainability linked loan, what the bank will do is to basically tie the interest rate it charges on also whether the company reaches certain ESG targets. So if the company is basically charged an initial interest rate and then has to pay an interest of CS per period, and if the company reaches the targets, that interest payment could be reduced to a lower amount, but if it fails, then in a sense, the company would be punished and the interest rate could increase. So it's kind of like a step up and step down option type of contract. And the reason that we specifically focus on sustainability linked loans is basically the recent developments. So banks have been increasing their sustainability linked loans to companies of different sizes. So this is the blue bar that you see in the graph, especially in the last 5-6 years. So it is interesting to look at whether this instrument is actually addressing or has effect on the company's ability to improve their ESG profile. So what we're going to do is basically, well, in terms of the literature, there is some literature that exists on sustainability linked debt in the literature. So most of the papers have looked at it from the equity holders' point of view. One interesting question is, of course, whether sustainability linked loans are better suited for low ESG companies or low ESG risk companies or higher ESG risk companies. But of course, the literature has come up with reasons that they may be more relevant for higher ESG risk and the lower ESG risk companies at the same time. So, for example, if a bank wants to incentivize a high ESG risk companies to commit to improving its ESG profile, then a sustainability linked loan would be better suited to those companies. But you could also think about this from the corporation's point of view, which may wish to basically signal its quality in terms of its ESG reputation, which basically means that they would actually go for sustainability linked loans, knowing or hoping that they're not going to be charged a higher interest rate because they already have a high level of ESG reputation. So the argument could go both ways, and this is kind of why it is interesting to kind of frame this into a model to see whether it would be more suited to one or the other way. And we would like to look at this from the bank's point of view, so the bank's risk management or the bank's profitability point of view. So I'll just give you some elements of the model. I say the elements of the model because we're still discussing different cases. So for now, I'm not going to be showing you any results, but hopefully maybe in September, once we have the results, perhaps we can show the results as well. So in terms of the model, what we have is a company that has to borrow a certain amount to make an investment. And this company faces both the market risk, so this is what we call the conventional risk. For example, it could be due to fluctuations in demand, and it also faces physical risk. So market risk will basically take the form of some random movements, a diffusion process, whereas the physical risk, we model it as some kind of jump process. So an extreme weather event suddenly arrives, for example, which may lead to the cash flow generating ability of the firm. So our XT would be the cash flow process of our firm. So we try to look at both the conventional market risk and the physical risk. And then, of course, we have to think about the ESG profile of the company and how we can tie this to the sustainability-linked loan. So to that extent, what we have is we assume that the company uses a certain input, let's say a certain amount of capital, and a portion of that capital at least is producing negative externalities. So what we say is that the probability of reaching your ESG objectives is inversely related to the amount of this capital that produces negative externalities. So that's why we have some kind of this K0 would be the portion of the capital that produces negative externalities. So the probability that the company reaches its ESG objectives, let's say in the next instant, is given by a function that is inversely related to that amount. And then, of course, the idea is basically the bank will look at certain points at the firm's performance in terms of its ESG performance. And then if the firm has attained, so if this probability has been, the company has actually attained its ESG objectives, then the interest rate will be dropped to CM. Otherwise, it will continue at the higher level of CS. So that's kind of the idea behind the model. So these are initial reflections. So what we would like to answer is, of course, we're looking at this from the point of view of the bank. So we're going to look at it from the point of the profitability of the bank. And of course, is risk management. So cases where the asset value of this corporation is sufficient to pay back the loan. And of course, we're going to try to assess optimal interest rates or the interest rates to set and compare it to a standard loan contract in the context of these different cases that I discussed at the beginning. So the trade-offs. So as I said, hopefully we would be able to present the results at a later point in time. So I will just stop here and thank you once again, all of you, for having us. And if you have any questions, we will be happy to get back.
Thank you very much. Let me give a hand of applause to you, Sandra, Baran, and Qing, for this interesting presentation. This paper is very well motivated, looking at issues of sustainable finance. And clearly the overview or survey of the issues is very comprehensive, showing also the main drivers, recent developments, and some of the challenges. And then the attempt to actually tie down this in terms of the theory is also very convincing. And now here we have a model that could be used to do some further estimation or do some analytics to show us how sustainable portfolios, especially bond or debt instruments, could work for a sustainable future. Work for companies, work for investors, and work for the economy. At this particular time, globally, at this time of a global liquidity crunch, this paper is very timely. Now, this is now time to go into the issues as this is work in progress, as the authors point out. Definitely more data, more analytics, or maybe even simulations would take this paper to a higher level. And if the simulations then could be based on recent data, because what is curious for us, I think now academics as well as policymakers, is how the whole world of green finance or sustainable finance, climate change issues, how they're going to change in this world after COVID-19 and given the current Russia-Ukraine conflict. Is sustainable finance going to be one of the areas that can put us on better trajectories for financing future growth or financing recovery? And so I hope that any simulations from this theoretical model or potential forecasts, maybe stochastic simulations or forecasts, are pointing to, say, 2024, 2025, 2026. After that, it becomes a fairy tale. But if they can just forecast for the next couple of years, how governments and how companies can leverage on sustainable finance perspectives, ESG compliant investments, then that would be absolutely helpful. Now, but let me also one aspect which is particularly interesting is that the two figures slides on the slide, when you are comparing traditional finance with sustainable finance, I think that's absolutely helpful. And I think as ESG takes root, okay, we will all be gravitating from traditional finance as we have known it into sustainable finance. But maybe if you don't mind, Sandra, if you could go to back to those two slides where you showing, yes, that's it, absolutely. I found this very, very innovative. I like it very much. It is showing us where we have been, because finance is a very recent discipline. Finance was born in 1958, just yesterday, by the work of Miran Monigrian. So now we are taking back from 1958 to the current, where we are now. And then trying to see that if we incorporate ESG in finance, we are now be able to evaluate projects or investment or portfolios much better. Having said this, I am inclined to suggest an adjustment. The economic benefits are very well, known. You are working. This is like a cost-benefit analysis of traditional finance versus sustainable finance. That's brilliant. And the decision makers, whether in companies, whether in central banks, whether in ministries of finance, could do this type of analysis from where we have been playing for the last 50 years to where we could go in adjusting for environmental, social, and corporate governance, ESGs. Now, the only thing in this analysis is that we have economic costs. If economic costs are less than environment and ESG, if economic benefits are less than ESG costs, then you reject the project. Admittedly, yes. And if economic benefits are greater than ESG cost, you accept the project. However, the ESG is incorporated into analysis in terms of costs. But ESG also has benefits. For example, we know from recent work that companies with the high ESG components enjoy a share premium. So if you look at their shares, either in terms of dividends or in terms of share price, then you work out a return, they are likely to have a higher return, a premium that you could just say is explained by ESG. So maybe the economic benefits are just as taken. Maybe the ESG is not the cost. Maybe it's a cost minus benefits. The net is the net cost or net benefit. Just kind of a suggestion to there. But so our critique is that ESG has both costs and also has returns, and that could be demonstrated by taking a bunch of companies and then see the performance in terms of returns, both the dividend yield and also the share price or the capital gains, and to establish where ESG generates my high returns or in terms of dividend yield or higher capital gains. So that's just a kind of thing to, yeah. But anyway, I like this presentation. It's gonna give a million thoughts, possible extensions, PhD theses in these areas, other papers, collaborative or whatever. So this is a brilliant contribution to the seminar and introduction. So let me go. I think there were some posts in the chat, but I think this is what I've been mentioning. So let me now open the discussion to the floor. Please click on raise hand, and then I'll call upon you to intervene. I can see already hands going up. So Hong first, and Charles Corrigan second. So Hong.
Yes, hi, thank you. So thanks for the presentation, which is definitely very up to date and interesting. I actually have two questions or comments. So I will start from your theoretical model. So the third part of the presentation. So in that model, I understand that you are standing in the shoes of banks, and you try to encourage sustainable linked loans. And I have two comments on that model. First of all, your objective function, I didn't see the objective function, but you said that the objective is to see whether or not the borrower or the firms are, okay, the firms are the firms that do not produce a negative externality. So my first question is whether or not this is the objective of sustainability, or do you consider any firms, do you distinguish between firms that do not produce negative externality and firms that produce positive externality? So that's one question, a query, whether or not you distinguish between those two types. So my second question regarding the model is basically the very traditional conventional finance theory, and that is the lemon problem. So we all know that the lemon problem exists when firms are going to the credit market asking for loans, and that is already well documented. I wonder whether or not this lemon problem also exist in terms of, let's say, sustainability linked loans or green loans, let's say. So whether or not, so at the end of the day, if you, the lemon problem means that you are not able to distinguish between higher risk and lower risk borrowers. Therefore, at the end of the day, the equilibrium will be okay, because you are not able to distinguish them, you are charging higher interest rate in on average or in general. That will crowd out some firms that are actually of good quality. So in this case, of lower ESG risks, because they trust themselves, they think they should be treated better than this. So therefore, in that ESG market or sustainability linked loan market, probably the borrowers, other borrowers that are of higher ESG risks. So I wonder if I apply this conventional theory to your model, whether or not this problem remains for this sustainability loan market. So that's my two queries or comments or questions on your model. I have another question regarding the statistics. So I remember, so that was the second part of the presentation. I saw the development or the pattern of the green loan statistic, and I saw a very dramatic drop in 2022 as compared to 2021. So I just wonder how to interpret, how to explain this. Was this because the war? So why after 2022, the green loan, I forgot whether this is the issue, number of issues or the value of green loans, but it dropped sharply. So maybe you can explain a little bit more. And that drags the relevance of the Ukraine war. So after the war, probably people are thinking about ESG differently. So that's my question. Sorry.
Thank you very
Okay,
much, Hung. Yeah.
So thank you very much for your questions and comments. They will be very useful for us, especially in terms of the model. So do we distinguish between negative versus positive externality? Well, in a sense, yes. So if you look at this portion of the model that I suggest, so it is kind of perhaps an issue of calibration. So there is the portion of the capital that kind of produces negative externalities, and obviously if that capital is low, then the company is not producing negative externalities. But if you mean in the sense whether the company is actually engaging in something that produces positive externality, it is not there as yet. So it's a simplification. So we're focusing on the negative externality, and we can play around with whether that negative externality is significant or less significant in our simulations. So that distinction should come here. In an extension of the model, of course, we could say that, well, the loan contract, the sustainability loan contract will stipulate that, for example, this K0 is deemed to be too high for the company and it has to be reduced to another level. So that, and that also has the effect that, I'm sorry, that also has the effect that the probability of attaining the goal is higher. For the lemons problem, well, it is not in at this point, but it is well taken. We're trying to look at this from the point of view of the bank. So we're not really looking at whether the company, seeing that it would be charged a rate higher than it otherwise would have been, would decide not to basically engage in this market. We're not looking into that, but this is more the bank's profitability or risk management process. So it is probably not going to be explicitly in the model.
Maybe can I want just to share a debate that is among us, and I think that maybe the debate will be interesting also to the others, because about this model and the problem how to distinguish the different borrowers. We're just discussing among us by saying, okay, maybe if we stand in the shoe of a bank and for the sustainable projects, we try to make maybe we try to define some characteristic according to firms that declare that they will be engaged in ESG process with positive impacts. Because in this current era, we have such kind of firm that are startups and that are just investing themselves in such kind of way. And the target and the result at the end will be that they have to have positive externalities. And when we were just discussing, we said that maybe we can have three types of borrowers. The standard borrowers, where we know, and it is why also when Baran was presenting, he talked about standard loans and sustainable loans. Because we try also to distinguish two types of loans, the standard one, standard loans related to standard borrowers. And when we take the other part related to sustainable project, we divide into to try to understand. And I think it is not clear also for us at this level, but to try to understand the different type of profile of borrowers. So we have those intentional borrowers. And it is why at the beginning of our thought, we present two types of characteristics of borrowers that we can have for banks. So intentional one and additional one. So intentional one, all those firms that were created and dedicated for all those transitional process or maybe ESG process and impacts. And for the other type of borrowers, we have those who are just having an activity that was just existing and they have to adapt themselves and include such kind of issue in their production process and decision making. So due to this, they have to change a little bit their view and the way they are just developing now their activity. And when we try to split the two types of borrower like this now, we just relate the level of risk according to the type of borrower. So for the intentional one, because we think and we are just a little bit short, not 100%, but according to how it is designed, we think we just expect to have a low level of risk. And maybe here we have also to distinguish about the development of the startup, because it is also tied to the type of activity. Because sometimes we have to take in consideration the type of activity of the firm and the implementation of the firm, also the geographical area. So when we combine all such kind of hypotheses, we can describe now a positive ESG profile borrower, if I think I'm just explaining clearly. If not the case, you can just correct me. So we have just trying to put in place a positive ESG profile related to such kind of borrower. And for additional one now, we have designed, and for additional, we say that we can have two types. Bad ESG profile, because they said they will do something and at the end, the result is not there. And we can have positive ESG profile now for the additional one. So to handle a little bit that part that the theory is mentioning and how we can control, because the issue here is trying to value the level of risk and trying to control in the point of view of the bank. So it is well designed a chart where we can well characterize the frame, the activity, the localization, and so on, to try to say, okay, as a bank, if we want to involve ourselves in such kind of process, it could be easy for us or not to handle the level of risk. And because we are just splitting more in detail such kind of characteristic, sometimes we lose also ourselves in the different, I can say in the model, the different coefficient or maybe the variables that we're just introducing in the model. It is why also the equation that we're sharing today, it is just a simple one to give you also a simple overview of the beginning of our thought, because if we put everything, I think that we will lose you as we were just losing ourselves also during the discussions.
Okay, and for your last question about the figure, go back. Okay, about this figure, I found this figure from the website of the Central Bank of France. Actually, according to the article, they mentioned that the green bond issued increased twofold in 2021, and in the volume of 2022 are expected to climb even higher, because here for the figure, they just show the volume of the first quarter. It's not the volume of the total year.
Okay,
That's why
that makes sense.
it's a big decrease. Okay.
Thank you.
Because this article is published during in the June of 2022. That's why they don't show the total volume.
Yeah. Okay, that makes sense. Thank you. Yeah.
Yes. Okay. Thank you. Thank you for your comments and questions.
Thanks, Lid. Thanks so much, Hong, for initiating this discussion and exchange. And thanks, Sandra, Baran, Qing, for those responses. Very rich discussion. So I can see additional hands up. I'll take Charles first and then JD. Charles, good to see you online. How are you?
Hello, everyone. Thank you for taking my question. Hope you can hear me.
Yeah, sure. Yeah.
I want to go back to that nice plot, the one with the traditional versus sustainable financing with the crossover. Yeah, that one there. The first thought, as soon as I saw that plot, without any thought whatsoever, the first thing I thought about was internal rate of return, and I know that Professor Murinde talked about 1958 again, and that brings up Modigliani and Miller. So, and then of course, it brings up in my mind optimal capital structure. Anyway, where am I going with all of this? The point is, wouldn't it be nice, and I don't know if this is a separate paper for you guys or if based on what you already have in place, you can do this. But boy, it would be great to get like a quote unquote optimal internal rate of return, a rate of return at that crossover point based on whatever criteria you have in your model, at which the economic benefits, for ESG, is just balanced. In other words, like an equilibrium point, a tipping point beyond which, the project will be feasible or not. Is that in the context of your, this is for the authors. I don't know if you guys have discussed that or if it is something you think in the context of what else you're doing, it might be feasible either in this paper or perhaps in another paper. Yeah, that's my question.
That's a great comment, Charles, indeed. So it would be an internal rate of return, adjusted, yes, for ESG. What I think is a brilliant idea, but let me pass over the comment to Sandra, Baran, and Qing.
Maybe at this level, I don't have maybe a clear answer about this. Maybe trying to continue to think about.
Yeah.
Yes.
Yeah, I think it's another positive way of reconfiguring this problem, because the more you invoke alternative theories of explaining the same phenomenon, the more you actually, getting solid, building up a solid, theoretical framework, which does not crumble whichever, competing theories you subject the analysis to. So I think that's kind of another way. And given that a internal rate of return is one of the important yardsticks we use in traditional finance, one is to see how it is adjusted when you take the excursion into sustainable finance. In fact, because here I think the equivalent of benefit cost would be like using the NPV. There is actually even more extension of it, that if you are going to, because the NPV, internal rate of return, are not adjusting for risk. And if we wanted to kind of adjust for risk and use standard, in traditional corporate finance, in taking risk into account, then you are using either the CAPM model or a farm of French model, or even extend it and use real options model kind of the finance. I think you're gonna go wild. Basically, you started on a project that's brilliant. You're gonna go wild as you extend this kind of analysis, but homing in ultimately to the fact that sustainable finance is a very promising way of extending the traditional finance that we have had since 1958 or thereabouts. Good, excellent. Okay, see my colleague Jaideep.
Thanks, Victor. Hi, everyone. Thanks so much for an excellent presentation. It was quite broad in scope as well. So I have a couple of questions about the sort of the implementation of the sort of the design for the model for the bond that you want to issue or sort of price, let's say. There's this idea of a low and a high interest rate, and it's linked to a sustainable objective. Now, that's where all the action for the pricing comes in, right? So what exactly is this objective? How are you going to measure it? And how are you going to link it to a low and a high interest rate? That seems to me like a big challenge and a kind of problem in making this work, in the sense that it'll be great as a theory, but how you would make it work in terms of having someone adopt this kind of bond structure. For me, one of the reasons that this low versus high interest rate sort of becomes a concern is when I look at the data on the, so if you go 2 slides down from here, you have this data on like the total issuances of green bonds. Now, all of these bond issuances are probably not new financing. At least that's what I suspect. I think that a lot of it is refinancing by organizations that can classify their bonds as green. Now, when that happens, does it suddenly mean that their interest rate drops? Is the same organization borrowing the money from the same bank? But now that because they can classify their bond as a green bond, does that interest rate drop? Or is it that you're now going to penalize firms that are already green, as Hong was kind of referring initially, uh, by only thinking about changes in the sustainable performance as being rewarded with a drop in interest rates? Those are kind of sort of the practical implementation questions that come in with the CLCH. That to me is like the kind of sort of key point. And I was just wondering if you've thought about this a bit more, if you want to share something with us about that.
Yeah, so thank you. I think we're going to start simple. So one way to model this is you start with a certain interest rate, and then if the company obtains the objectives, you lower it. If it doesn't, it is increased. So one way of simplifying it is just in terms of no punishment, but only rewards. And then we have to think about our timeline. So one, at least for starting, we could think about some more perpetual type of debt so that we can kind of simplify the model and solve, at least get an initial idea about that model. But I think what we're going to use as an approach is more like a real options type of approach, a dynamic programming type of approach. So we're just going to kind of use backward induction to get the firm values and then get an initial firm value. So what this means, and I think this also relates to the previous question on the model as well. So what was the bank's objective? What is the objective function? So if we're talking about, let's say, the bank's risk management, then what we care about is looking at the probability that the value of the asset of this project does not fall below the initial amount that has been borrowed. So those will be kind of the indicators that I think we have to think and try to implement. But of course, it's a bit challenging, especially because, I mean, if you think about it, so let's suppose you have set periods of evaluation of the firm's objectives, whether the firm has attained or not. And each time the interest rate will change depending on the objective. So that is going to pose a little bit of a problem, perhaps. So we have to think about ways to maybe intelligently deal with that problem. But so they're still ongoing, I would say.
The mic is off. The microphone is off.
Sorry, thanks. So I was just maybe I missed this, but when you say the interest rate is going to drop and go up, like how do you work that out exactly? Maybe I missed that part. So how do you determine how much the interest rate goes up or down? Is this part of the bank's cost sort of optimization, or where exactly is this sort of the scale, the size of the drop coming from, really?
Yeah, exactly. So right now, this is not something that I showed you, but ideally, if we can write the bank's profit function, then that is where it's going to show up. So at this point, we're not there yet, but so it's going to be, in a sense, that's where it's going to show up.
Okay, so if the bank's profit function is now going to have like multiple dimensions, right? So you're going to have the actual profit plus you have this kind of ESG benefit. Is that correct? So you're going to put a monetary value on the sustainable objective?
Yeah, so that's a good question.
Okay.
Yeah, but we have to think about that.
Okay, thanks.
I have to think a little more about it.
Thanks indeed. And Hong has just posted a comment in the chat. Hong, can you go ahead?
Well, I thought I already. So I just, I mean, the authors responded by emphasizing on we start simple. The simpler, the better. Yes, of course. But the banks decision because you are deciding the interest rate, the price of your product. And that determines how much you can lend, right? So that determines your profit. And that decision is endogenous to your borrowers. So therefore, to me, you need to think about the objective function of banks that contains the borrower's characteristics, particularly in this case, the risk of ESG. Okay, so I think yeah, I mean both Jagdeep and me, I think we try to make a point on this, but I think yes, the simpler the better, but I think this is a very obvious endogenous problem, and that's my comment. Thank you.
Thank you indeed. Thank you indeed. I can see we're almost running out of time, but if colleagues or the further comments, please put up your hand and we can round up some of these comments. But overall, this is a brilliant paper, a great presentation that has excited our thinking and appetite and push to go into the sustainable finance arena. With the an extension or further work on the paper and maybe also calibrating the theoretical model and doing some simulations or illustration with numbers, this is a absolutely interesting work on its own and with great potential of generating another project or another paper of great interest. But I hope that by September, by the time of the conference, we will have a new paper with numbers, with the, that's absolutely interesting, also interesting. And just, a contemporary issue, you can't go wrong. Yeah, so, thank you very much. Maybe if you have any concluding shots, or do you want to have any last words as we close? Let me give you the floor to say something to us as we close.
Well, thank you very much for having us and those comments. I mean, they're going to be very helpful to construct the model, to think about it, because there were some issues that were not clear. And what I mean is we should probably start with a simple model, but of course, that's not to mean that we should stay at that simple level, but think about to make it more realistic. So we're going to, I guess, take a step-by-step approach, and those points will be important to look at. So thank you all for being there and for your feedback.
Yes, thank you.
Thank you indeed. And yes, the theoretical model is interesting, and so the insight before you go into the model, that's brilliant. It takes everybody, at the same rate of understanding, from the Paris outlook, and then the issues up to now. That's brilliant coverage. So thank you indeed. And let me take this opportunity also to thank you all participants for being able to come and participate in this interesting seminar. And let me also invite you for the follow-up seminar next week on the 24th of May, same time in Teams. Will be taken by one of the participants in this seminar today. I can see Professor Tumoamua from Brunel University, London, on the effect of capital flows on the imports of capital goods in developing countries. So I did look forward to see you next week. But for now, thank you very much. We share a hand of applause. Thank you and bye-bye.